I think we're sort of in trouble when it comes to the markets. I think that the Fed, Ben Bernanke, has placed the Federal Reserve in a trap that they cannot get out of. It. They can only make it worse. Every time they do more currency creation, it's going to make it worse. Every time they fiddle with interest rates, it's going to make it worse. These negative real rates are going to persist on the average. You're going to see these little bursts like we've seen since the year 2000 of positive real rates. But this trend of mostly negative real rates is going to continue. And this trend of upward gold prices going up and silver following, and then silver will blast past gold as far as percentage returns. And it's going to be huge.
Gold and silver prices are experiencing solid gains in midday U.S. trading on Thursday, driven by a U.S. inflation report that, while slightly warmer than expected, was still deemed manageable. Additionally, there was an unexpected rise in weekly jobless claims, further supporting precious metal prices. Mike Maloney, a renowned expert in the precious metals industry and founder of goldsilver.com, predicts that the long-term trend of negative real interest rates will continue, further fueling the rise in gold prices. He anticipates that silver will also perform strongly, likely outpacing gold in percentage returns. As of Thursday, silver prices remain unchanged, trading at $30.52 per troy ounce, a slight increase of 0.05% from Wednesday's $30.51. Silver prices have risen by 28.28% since the beginning of the year. Overall, the latest U.S. economic data is favorable for the metals markets, suggesting that the Federal Reserve is unlikely to alter its easy monetary policy stance as the year progresses. Maloney emphasizes that negative real interest rates, which emerged after the Bretton Woods system ended in 1971, have historically driven gold prices upward. Although owning gold was illegal in the U.S. until 1975, the sustained negative rates helped solidify gold's reputation as a safe haven asset. Historical trends show that gold prices tended to decline significantly during high real interest rates, such as in the early 1980s. In contrast, during periods of low or negative real interest rates, like the post-financial crisis era, gold prices soared, particularly in the second half of the 1970s when inflation outpaced bond returns. A similar scenario unfolded in 2001, when the Federal Reserve reduced nominal interest rates to zero, substantially increasing gold prices. This historical context reinforces Maloney's view that the current economic landscape favors precious metals as a hedge against inflation and financial uncertainty. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Yes, I have, but I do consider it one big bull market from 1999, 2001, the double bottom that we put in, to today. I'm probably the only one that considers it one big bull market. But I look at something you and I really spent a lot of time on called wealth cycles. And so I'm looking at the bull market as to when gold bottomed against other assets in society. And that was basically 1999, 2000. And it's just on the way to becoming overvalued, but it's still tremendously undervalued when you compare it to the Dow gold ratio and things like that. And, it's gaining ground on real estate. So anyway, yes, this chart just shows that there's very little gold is once it's in this fundamental bull market, it doesn't really matter whether the rates are rising, falling, or going sideways, like you say. Gold, on the average, is rising compared to the US dollar. It's rising in dollar terms. I do want to point out for the viewers that, if you look at the 70s, there's that first red blip of negative real rates. And that blip pretty much corresponds to coming off of the Bretton Woods system, Nixon closing the gold window on August 15th of 71. And then it's blue for quite a while during that first rise. So it's positive real rates. However, that part of the bull market, the U.S. wasn't participating. It wasn't legal to own gold in the U.S., and it wasn't being traded as a commodity on the Chicago Mercantile Exchange until the first day of 1975. So that blue area, when you're measuring U.S. CPI, gold really had not that much of a relationship to it because it wasn't legal here. It wasn't being traded here. It wasn't the safe haven asset that you run to. But it is interesting that most of that decade, when gold was rising, you see the negative real rates. Yeah. Another thing that I want to say is that the CPI became the CP lie in the early 80s. And so from the early 80s to today, if you want to sort of make this real, what you've got to do is tip it more toward negative real rates. You got to bring down the today. I think that what people need to ask themselves since the year 2000, gold was 250, now we're over 2,500. So the dollar's purchasing power against gold is down by 90%. Do you think the dollar is going to gain in purchasing power? I think you are right. I think there is still stored up inflation because you didn't see that complete offset. So I think the interest rates, they're going to be at 3%, but we are going to see inflation higher than interest rates, giving us negative real rates. So yeah, I think we're sort of in trouble when it comes to the markets. I think that the Fed, Ben Bernanke, has placed the Federal Reserve in a trap that they cannot get out of, that they can only make it worse. Every time they do more currency creation, it's going to make it worse. Every time they fiddle with interest rates, it's going to make it worse because we're under this new era of Bernankenomics. And these negative real rates are going to persist on the average. You're going to see these little bursts like we've seen since the year 2000 of positive real rates, but this trend of mostly negative real rates is going to continue. And this trend of upward gold prices going up and silver following, and then silver will blast past gold as far as percentage returns, and it's going to be huge. That is my take on all of this, because it's whatever you think the dollar is going to do, you got to bet on the opposite.
In September, the U.S. Consumer Price Index rose by 0.2% month-on-month, surpassing expectations of a 0.1% increase, and recorded a year-on-year rise of 2.4%. This is a slight decline from the August CPI, which showed a 2.5% annual increase. The core CPI, which excludes food and energy, increased by 0.3% month-on-month, exceeding the anticipated 0.2%, and saw a year-on-year increase of 3.3%, up from 3.2% in August. Amid these trends, MikeMaloney expresses concern that while the CPI has shown some moderation, inflation will likely resurface. He underscores the probability of negative real interest rates persisting, indicating that the current economic environment is intricate and precarious. The Federal Reserve has indicated that the combination of slowly cooling inflation and a firm but potentially vulnerable job market may prompt further interest rate cuts in the upcoming months. However, some policymakers suggest that it might be prudent to forego a rate adjustment in November, reflecting the delicate balance the Fed must navigate as it responds to evolving economic conditions. Let's get back to the interview.
If you look at the amount of currency creation that happened right during and after the pandemic, go back to the chart that had both the CPI and this on there, and shorten the time scale too, to just sort of focus up on since the right here. Shorten the time scale to about there. So the dip below the zero line for the M2 has not offset the big increase in M2. Now, a lot of this is in the markets. And so M2 doesn't just go to consumer goods only. It goes into real estate, and it goes into the stock market and so on. So we've had this reduced CPI, and it's going to be coming back. But I think that I think we've got big negative real rates coming, is my point. But there is inflation. We've got negative real rates that are coming. This is a hard one to figure out, but go on. This is a very good analysis of ways to predict this. All of that currency creation, a lot of it was soaked up in the stock markets and so on. A lot of that, I think, is going to be vanishing soon. So imagine 1982, roughly, that peak in real rate and in real rates. From there, just take everything and sort of tip it down just a little bit, because it is now the CP lie. They fabricate so much information with hedonic adjustment and replacement and just all of the different tricks they do to try and massage the numbers and make them look a little bit better than they really are. And then the CPI doesn't incorporate true inflation where, the Federal Reserve, the way they create currency requires them to pump that currency into the markets. It's currency when the Federal Reserve is creating currency. It's going through the biggest brokerage houses in the world, and it's going directly into the bond markets, and that thus, once it's in those trading houses and so on, it ends up in the stock market. So they're not measuring that inflation. So this whole thing is actually, these 2 decades are actually more negative than it looks because they're not measuring all of inflation. And then another thing, incrementum always uses annual data. So it isn't really showing, at least on the gold price, it isn't showing the true peaks in gold there. They're always using annual data instead of, or monthly instead of daily. So we're not seeing the true peaks in the price.
Gold and silver are gaining traction, bolstered by a recent inflation report and rising jobless claims, which suggest a continued supportive environment for precious metals. With predictions of ongoing negative real interest rates, these trends may strengthen the appeal of gold as a haven. Historical patterns indicate that periods of low or negative real interest rates often lead to substantial increases in gold prices, suggesting that the current economic climate favors further gains for gold and silver. Given the current economic indicators and historical trends, how do you anticipate the dynamics of precious metals evolving shortly? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.